Hey everybody. This is David Paul with the Capital Stack podcast. Today I am with my man Ryan Collins, who is the principal at Noro Mosley Partners based out of Atlanta. It is a venture capital firm that has how much under management now?
A few hundred million.
Few hundred million, and they focus on SaaS, software as a service, as well as healthcare IT. Ryan has board affiliations with Medix Infusion, Aunt Bertha, and Upward Health, and he is a really great financier of early stage healthcare IT companies. And we're going to try to break down a little bit about healthcare IT and the healthcare system and what's real and what's not. And really looking forward to having him on today. Ryan, how you been?
Been good, David. Good to reconnect. Appreciate you having me on.
Absolutely. So, Ryan, tell me a little bit about how you jumped onto the private equity venture capital, bandwagon, because a lot of people think that's an impossible feat to jump into.
Yeah, absolutely. So I kind of started investment banking and worked in kind of lower middle market investment banking for a few years. Did that, went over to kind of larger private equity buyouts, companies doing 10 million and up in EBITDA at a firm called the Riverside Company, where I was largely a generalist, but a decent part of my time there was kind of spent in the healthcare space, doing kind of provider roll ups a lot of the times, and was there for a few years. Wanted to move kind of earlier stage, work with fast growing companies, and
Was
got my
that your first? Was that your first exposure into healthcare?
I had done a little bit of work on the healthcare side in banking, on kind of like healthcare consulting. So I'd probably spend a third to a half my time in kind of each of those roles on the healthcare side.
How did you break into that? I mean, like, was that something that was just kind of pushed onto you, or was that an area of interest?
Um, a little bit of both. I mean, I did have an interest in the space generally, but also kind of in both of those roles, it was kind of as deals came through, who was available to work on them.
And you were always at the office, right?
That's right. That's right. I was usually around
You look like the
working late.
guy that would literally, like, I would push off my work too.
And that did happen. That did
Yeah,
happen.
you were that kind of guy. Okay, I like it. I like it. And so you then all of a sudden got a bug that you wanted to do early stage stuff.
Yeah, yeah. Wanted to move earlier stage, kind of work with companies that were growing really, really quickly, and that you could, maybe have a bigger impact on changing kind of the growth profile of those. And went and got my MBA, and was looking to kind of at maybe one of five cities, and Noro Mosley happened to be recruiting at the time as we were raising our eighth fund, and so I was able to kind of join them at that point.
Yeah, and I mean, how many applicants did they have at that time? I'm sure it was pretty robust.
Yeah,
And you were out of town too, right? So I mean, like, it's
yeah,
hard to
I
get
don't know
that
how
job, I
many
would imagine.
exactly, but I know it was competitive. I think fortunately, I had worked in Atlanta previously, and so Atlanta's a tight knit kind of finance community, and some of my bosses at Nora Mosley knew some of my former bosses from banking, and the kind of experience lined up with what they were looking for.
And I'd love to hear a little bit kind of about your transition from literally like doing LBO buyout, roll up, financial engineering type ways of finding alpha in the markets to this whole qualitative cash burn type of mentality and venture, and how you were able to get your head kind of wrapped around that.
Yeah, I mean, it's certainly a change. I'd say the biggest thing is like when your role changes so much. You go from uh, kind of pure execution, dealing with lenders, dealing with investment bankers constantly, building highly detailed monthly models, and to your point, kind of financial engineering in many cases, to hitting the road trying to find kind of diamonds in the rough on the sourcing side of things, and in this in this environment and doing a lot more kind of market work. But I think some of the things that I was able to do at my last job have translated to this job, helping companies with add-on acquisitions, modeling those out, helping them on their building out their reporting capabilities. So there's overlap, but the roles changed. And
You
how,
do that stuff for your portfolio companies?
yeah.
That's really nice of you.
Yeah, I mean, it's certainly increased over the last year. I think you're starting to see a lot more companies kind of come to market, and we've seen some of that across our portfolio. So they typically have never done an add-on acquisition before, and so we try and help them think through that.
Mm-hmm. I've once done that, with a less financially savvy founder, and I remember building out this, really. I mean, I think my models are beautiful, and isn't it like suck when you work so hard on a model and you give it to somebody and literally they appreciate it like not at all, like.
Yeah,
I mean, like hours go on to it. They usually use it as a tool to just look at one number at the end.
right. Or find a bug across the five tabs. That's
Yeah.
fun.
Yeah, this is wrong. Yeah. Yeah, no, that's it. Well, anyway, so what my experience was is I built out this great model, the metrics, the benchmarks, and he said thank you, and then I'm sure he never opened it again, and then he built his budget off of that and just bastardized my model, like after that, and you just bring it to board presentations, and it would just make me cringe
Mm,
every single time.
that's rough.
I know, but we made some money on that one, so that was good. So you know you're working. You do some. I mean, you work kind of. Nor Mosley's kind of Series A, right?
Yeah, Series A and Series B. Of late, probably closer to Series A, given how big some of the Series Bs have been.
Mm-hmm. And so some of these companies have scale. Getting acquisitions kind of makes sense. How do you feel about that when kind of companies that early are doing bolt-ons? Sometimes for me, like at that kind of stage, it kind of makes me worried because I'm wondering if they're either A, are they losing focus, or B, like is the market not as big as they say that it is, or like dot.
Yeah, I think it like right after we fund a company, if it's like in the Series A stage, it would be a harder time to go do an acquisition. I mean, one, I think they still kind of need to prove out their organic growth. Uh, Versus kind of looking to the inorganic side, particularly if it's maybe a software or tech-enabled services company. If it's a if it's a roll up or kind of the strategy from the get go is to go acquire a number of different companies and kind of scale through that, then it's a different story. I think that's a little bit easier on the services side, where there's less of a integration risk trying to bring together two kind of software platforms. I think once you get companies kind of in this Series B, Series C size range, if they're doing well, they may have some competitors who, um, maybe not aren't making it, and you might have an opportunity to kind of gain market share pretty quickly. So I hear you. Right out of the gate on kind of a Series A company, if they're saying we're going to shift gears to acquire a bunch of market share, I'd be a little bit nervous.
And pissed, right?
Right.
I mean, that basically, that just screams that your equity is going to get diluted, and you're kind of sold a mixed bag of stuff.
You want to at that point you're trying to just make sure that they can help develop the go-to-market engine, and that kind of the thesis that you underwrote to on the organic side is actually there.
Yeah. So tell me a little bit, because you're a smart guy, right? Tell me a little bit. I mean, Nora Mosley is very focused group, I would say, especially on the healthcare IT side. How do you go about kind of underwriting a thesis in the process that you go through in your head when you're looking at companies?
Yeah, I think uh, it's a number of different factors. It's leadership. Kind of has a CEO done it before? It's not a need to have. It's a nice to have. But if they haven't been a CEO before, kind of do they have experience in the industry? Looking at kind of their Go
What's
ahead.
the weighting? What do you put? If they've been there, done that, what does that mean for you?
Um, it like I said, it's kind of like it it can maybe overcome other maybe challenges in the broader kind of investment profile. So maybe you're able to take more risk on the stage of the company if the CEO has done it before, or maybe they have a bit more concentration or a more limited customer
Mm,
base, or there's other risk that you're able to take on if the CEO has done it before or has significant industry expertise.
that's a
But
good way to look at it.
yeah, it's just there all of the different things you kind of have to look at holistically and and see if like what the broader kind of risk profile is. I think. I mean, it's a combination of quantitative. Is this a lookalike product, or is this kind of a new category leader? Growth and churn, kind of you name it.
Yeah, and when you're looking at lookalike products and or products that might be like a feature, because I think about this a lot, right? It's kind of like Ben Thompson's bundling and unbundling of technology, and that's kind of really all that we see here is just distribution, coming in with technology and then kind of breaking apart and building really deep features. So, how do you think about that? Does it matter to be a platform anymore?
I think it should have the potential,
See,
but I think
I
that
asked the hard
eh,
questions, Ryan. You weren't ready for that one, were you?
right. Well, the hard part is that I think every single company describes themselves as a platform these days,
Exactly.
and so part of it is like parsing that out. I think to me, it's kind of like the platform thing is a little bit. It's not always apparent at a Series A stage. Some companies, it is. Others like our company Find Help, like initially they're moving into applications that I might not have guessed at on initially. I think part of it is you have to have like the organic growth story figured out, and then as if that comes to fruition, you will find other applications to bolt on to your offering or new products to launch or other verticals to expand to, and then you can kind of become the platform. But it's hard to do that organic growth initially if you're one of 10 companies in the space and you're fighting for mind share at your customers.
Yeah. So how do you think about what defines a platform for you?
For me, it's are you constantly getting the calls of people trying to partner with you? And
Ooh, I like that. I'm gonna write that down. That's going on your quote. That's good. That's really good.
honestly, I mean that if you think about like Find Help, they have a network of social services organizations that they work with, um, and then they have a freemium model that has people that are searching for social services, and that generates data. And there are a litany of applications for social services data and utilization of those social services and referrals to those social services. Um, and people trying to work with both the social services organizations and Bertha now doing businesses find help and their ultimate customers who are health plans and hospital systems. There are a litany of partners that are trying to access that data um, and so they've kind of emerged as a platform in the space.
Okay. And then when you're underwriting the deal, how do you know that that data is coveted?
I think it is when you're underwriting, it's kind of a combination of one, how much are they growing? Is the product sticky? And then it's talking to their customers. Is this something that you're using every day? Is this something that you're using as truly a system of record? Are there other applications where you can get this from pretty easily? And how automated is that data gathering?
Hmm. Got it. I love that, companies wanting to partner with you as a heuristic for being a potential to being a platform. I think that that's incredible insight.
Yeah, and it kind of comes about, like I said, it the companies that we've worked with that have kind of emerged is that it comes about in ways that I frankly haven't expected from the initial get go.
Yeah, like you didn't call it in your in your memo.
No, I mean, we underwrote to the organic case being a strong kind of profile, and then there might be other opportunities in kind of adjacent market segments, but I think the number of companies that Amp Bertha has been able to work with has probably surpassed our expectations.
Yeah. This is good. See, this is what I like about podcasting is that I spend about half of it selfishly asking questions that I want to know for myself, and then the other half like letting kind of people talk about what they're doing. So, I mean, like it's a really good medium for that. Um, okay, and so when you think about healthcare, are there themes that you're particularly looking at, or are you just kind of seeing what's from a stage perspective, if they fit the stage, and then you have conversations, then you kind of build the thesis around if it's got growth?
It's a little bit of both. I mean, we're constantly talking to kind of our different companies, but also our limited investors. We have um, some strategic limited investors that in the health plan world and in the health system world that we talk to constantly. What are your problems? And that kind of helps us form thesis. But it's also opportunistic. I mean, you can't drive every company that you identify from a theme to raise at a certain point in time. So you have to also be responsive to the deals coming in your door. It's a little bit of both. Ideally, kind of the way it works from a combination standpoint is you identify themes, and then as stuff from those themes comes through, that helps you sift through the 20-30 deals that are kind of coming in through at any point.
Mm-hmm. And then you kind of just have some pattern recognition there.
Yeah, it really in my view kind of helps from a prioritization standpoint more than anything.
Mm-hmm. Okay. And so you're doing some healthcare deals. Give me one deal that you worked on from start to end, and tell me kind of what excited you and how you underwrote it, and where it went.
Yeah, sure, happy to. We actually acquired a majority in a company called Medix Infusion. It kind of to your point around thematic versus opportunistic. It kind of came in from a cold inbound, so it was opportunistic from that standpoint. But we had been talking to some of our health plan partners, and it identified infusion as an area of that they're having a hard time with from a cost standpoint. And as we heard that from them and did some work on the space, kind of realized that costs were going up. A lot of volumes didn't need to be done in the hospital where they were more expensive than an ambulatory setting. And while we were kind of thinking through that, this deal comes across our door that that we became pretty interested in. So we acquired a
Do you use debt?
No. So the company had kind of a challenging balance sheet at the time, and that's kind of why they were looking for a new capital partner. And we did not use debt kind of in the acquisition, just to kind of expedite the closing, and the purchase price didn't frankly require it.
Mm-hmm.
And so we didn't at that time. We've since brought on a bit of debt to fund an add-on acquisition.
Okay. And was that all secondary, primary, or a combination?
It was about a third secondary and about 2/3 primary.
Okay. And did you bring in your own management?
We brought in at the time a CEO that we had worked with before, who was based in Dallas, where the company's located.
Okay. So but like that had to be a part of your thesis, right? I mean, like you had to have a guy to run it before you closed, or was this something like we're going to do it and we'll find the guy after?
It was. It certainly helped us kind of underwrite the risk. I think we liked the space enough, and kind of Medix's unique approach to infusion, that we probably would have closed without it. But it's certainly, to our point earlier about like how does it help you think about risk, having a person that we had worked with before helps you maybe get a bit more comfortable to other risks that you identified in the deal.
Mm-hmm. And you're a venture capital fund, right? Would you consider yourself venture capital, or would you consider yourself growth equity?
We kind of use the moniker early growth equity, which is basically a cheating way of saying somewhere in between.
Yeah.
It's we
I'm
take
whatever you want me to be, man. What do you want? I'll show you
right,
what I am. Yeah.
but it's it's companies that have real validation, customer traction, and have been de-risked from that standpoint. But sitting kind of below the firms that are investing at the 10 million ARR mark, where they've already got kind of the go-to-market engine figured out. So definitely an element of risk to it, but we feel like there are certain kind of like product market fit elements that companies have figured out by the time that we invest.
And you clearly, underwrote a return of something pretty substantial, right? Enough to kind of meet your portfolio requirements for this deal. But this deal is, not as high margin as a SaaS company. It's localized. So how did you think about that? I mean, do you do a lot of healthcare services deals?
Yeah, on the healthcare side, which is about 50% of our portfolio, I'd say maybe a third of our deals are healthcare services, and some of those are kind of traditional fee for service, like Medix. Some of them are more kind of value based and providers taking risk elements to it. Um, we underwrote part of the upside within Medix. One was we were able to get it for an attractive price, given the balance sheet dynamics that I alluded to. But two, um, it's a massive market and it's growing at a high single digit rate. And there's significant white space for providers like Medix to, build de novo locations in fairly quickly. And then when you looked at the unit economics, the cost of opening these ambulatory clinics is fairly limited compared to other kind of healthcare specialties. And so there's a massive market to chase, and there's going to be tremendous volume growth from new drugs coming into the market. Most drugs coming into the market are specialty drugs, and a big share of those are biologics, which Medix administers in its clinics. And then payers are shifting volumes out of hospitals and into ambulatory clinics where it's a lower cost site of care. So kind of a few different favorable tailwinds, and Medix had kind of a unique model that we thought could scale pretty quickly.
Okay. And, just for the audience's sake that might not be super familiar with healthcare or pretend that they're, familiar with healthcare, and I fall into that category, how do you classify on risk versus fee for service?
So from a providers taking risk standpoint, the way I think about it is in the traditional healthcare model, doctors get paid for each service that they provide. And so they're incentivized to provide more services. From a providers taking risk standpoint, they're paid kind of an amount that is based on the historical average of the cost of that patient or a population of patients. And then going forward, they're paid that amount, and they are required to provide the amount of services to keep that patient healthy or improve the patient's health. And if they're able to provide care and improve the health of that patient at an amount at a cost that's less than they're paid, then they're able to generate a profit. If they're not, they have to provide care at a cost that's higher than what they were paid based on historical averages. Then they'll incur a loss, and that's why it's called taking risk.
Okay. And it's an opt-in system, correct?
Yes. I mean, providers have to opt in to the program if yeah, and increasingly they're doing so. You're seeing more and more kind of providers looking to do so, especially with COVID, when you saw a lot of volumes and go away, and so providers are looking to get paid kind of flat rates to take care of patients, and if they're able to do so at a cheaper rate, there's significant upside.
Yeah, I can see that, but is there a stick with that carrot? If they decide not to do that, I mean, the reimbursements lower? I would think, I mean, the amount of logistics, I mean, to get these guys to do anything different is incredibly difficult. So, you're saying, hey, we need to somehow care manage this and work together to keep a patient out of the hospital. Who's in charge here? Whose fault is it? If one person drops the ball, we all aren't getting paid. So how does, what's the stick?
Yeah, I mean, it's a good question. So, the majority of healthcare spending is still done under a fee for service model. And a lot of the rapidly
How
growing,
much, do you know?
I would say it's probably 70 to 80% still,
Really? Okay.
from a volume standpoint. Now, this is the providers themselves. Now, it's changing, but part of the reason it's been slower to adopt providers taking risk is um, there hasn't been the stick that you alluded to. There has been a slower kind of mandatory rollout by the federal government, to kind of force providers into risk-based models. And initially, it started as hey, you'll get bonuses if you provide better care at lower cost, or hey, you can just generate additional upside for yourselves. And increasingly, I think they'll move providers into taking downside risk, where they're at risk for the cost if it exceeds their payment. But there hasn't been a ton of like stick for providers to get into it, other than the fear maybe of declining volumes.
Okay. Because the patient would opt into that, but that's probably not going to happen, right? Does the patient really know or care if they're a fee for service or accountable care organization?
Typically, they aren't thinking about that as much, or not familiar with it. But I'd say probably the greatest amount of familiarity they can think about it is through like a Medicare Advantage plan, where it's, in that case, it's not the provider taking risk, but it's really a managed care organization where the health plan is receiving the payment for the patient's risk.
So is there like a world where the government says, and I heard this anecdotally, but like the government, you screw up in a hospital, or you screw up as a doctor, and your patient gets put back in the hospital, sloppy discharge, what have you, and they opt to not pay you, right? Because it was a sloppy discharge. Is it because the provider is saying that we're not going to pay you, or is it because that doctor had opted into some kind of on risk platform,
Um,
or not, or do you not have enough information?
so is it the hospital is not getting reimbursed like by Medicare, or because of a sloppy discharge and they ended back? There are penalties by CMS that hospitals incur if their readmissions are above a certain rate.
Okay, so that has nothing to do with the actual the on risk programs.
It is in some way, like they both kind of fall under the broader umbrella of value based care, in that
Okay.
the outcomes of the patient are uh, guide the financial implications for the provider.
Okay. Okay. Great. So you underwrote the infusion company to a great return, and is it doing well?
It is. It is. They when we funded it, they were kind of just in Dallas Fort Worth, and they've now expanded kind of throughout Texas into Midland, Odessa, Corpus Christi, Houston, soon to be San Antonio. They bought a provider up in Oregon that was for sale, and they've launched another practice in kind of the Kansas City market. And I think that the thesis around volumes being driven by payers and new drugs in the pipeline has proven out. And we haven't had to, invest additional capital to achieve all of that. So it's been so far so good.
That's awesome. Congratulations on that. I like it when it actually works.
Yeah,
It's a
yeah.
really good feeling.
Can't say they all do, but yeah, that one has worked out so far.
So any other kind of portfolio company, you go ahead. I mean, Ryan, you need to start pumping your book. I mean, everyone else does it on podcasts, so you should be able to do it too.
Right. Yeah. Yeah. Well, I alluded to findhelp a little bit earlier in the social services space. It's an interesting company that has this freemium model that supplies data about the social services organizations in your neighborhood. And the broader idea is that access to social services um, keeps people out of the hospital. If someone is homeless, they're going into the hospital. If someone doesn't have access to food or a safe place, they'll end up in the hospital. And as a result, um, health plans and hospital systems are increasingly trying to connect their members and patients with these social services to lower the cost of care. And Aunt Bertha has a software solution that helps them do that.
And you underwrote them in the Series A?
Theirs was, I believe, a Series C at the time, but that was just because they had raised a few
Yeah,
smaller rounds beforehand.
that was the stage of stock, but not necessarily for
Yeah, it
what a
probably
typical
was about
company.
would be a Series B.
Okay. And so they probably had substantial data already in their system and people using it when you came in.
They did. They had a pretty broad customer base, and so we were able to feel comfortable that there was, significant demand on both the health plan and hospital system side of things, and enough data while it was early to get a sense of customer retention and average contract size and feel pretty good about the growth profile.
So I'm wondering, and so what I'm thinking to myself is, what did that company look like in its seed stage, in its Series A stage, and how did somebody get comfortable underwriting this when the data most likely was not in there, and there was probably really bad gross margins because they probably manually connected people, right? Like they were the algorithm, and their data was probably very spotty, and that, I mean, dot dot dot. I mean, how do you think about that?
Yeah, I think the earlier you go, the more you probably have to rely on kind of market and thematic based investing, and doing kind of more research, even if it's not a customer but potential customers. Hey, is this something that you would be interested in? Here's how we would think about an ROI for the solution. Is that how you would think about it as well? And then a lot of it, I think, comes down to team as well. And there's so much risk involved at that point that any sort of kind of credibility to the team helps you get a bit more comfort.
Yeah. So you talked about research and kind of trends and markets, and you said single digit CAGRs, right? When it came to your infusion business. And it makes me think about, all the reports that I read. And how much stock do you put in growth rates with all the market and markets and, type of reports that are out there? Because that's, really, I mean, that's how, if I'm writing a memo, that's for the data I'm using. I'm just like, please give me as much free stuff as possible.
Right. Yeah. It's I don't think it like I don't think I say, oh, this report's got an 8%, like let's go fund this company. But you know, the variance between market reports saying 1 or 2% versus 10, 11, 12 is fairly significant, and it's at least one signal. I think the other point is just like doing kind of your own work on addressable market and how many folks could actually use this, and how much are they, what's their current annual contract value, is just to me, a
Bottoms
better,
up.
bottoms up approach is a much better way to think through it, in my opinion.
Yeah, no, that's how I think about it too. I kind of look at it from a bottoms up and tops down approach. And Aunt Bertha, I mean, how were they able? And if it's the secret sauce, don't worry about it. But like, how did you get people, or how did they get people to adopt their software? And on the hospital side, because I'm literally was just talking to a healthcare IT company before we jumped on this pod, and you know Kager's there, it's a big problem, but the CFO is saying, what's the ROI? Like, and squeezing them on price. And you're telling me that people are dying in your hospital. It was basically a vendor management tool for surgical tracking and, keeping your implant reps accountable. And, they're telling me about this giant, huge pain point where people are getting sued millions upon millions of dollars. And yet, the CFO is incredibly resilient to try to implement a platform and squeezing down on price. So, I mean, how do you think about, sales cycles within healthcare and mitigating that? And, when do you actually have a product market fit issue versus like, I mean, I always hear, oh, what's a long sales cycle? Okay. Or like you're not good at selling it or you don't have product market fit, right? So, I mean, how do you think about that stuff?
Yeah, I think it comes down to like, does it actually fit within the workflows that are actually happening, and can you make it faster and more efficient? And uh, and that solves two problems. One, it means that people will actually use it if you're doing a pilot, and two, if it's doing that, in theory, there should be less labor or headcount that's required to do those tasks, and that allows you to get through one of the many gates in the health system sales process, which is the financial side of things. It helps you sell ROI, and then the other side of it is ROI, and one of those levers is headcount management. And so if you're helping drive efficiency, that helps with that. What I think, and on the healthcare side of things, what companies kind of run into sometimes is the inability to either fit into the workflows or sell an ROI that's actually valid. You can validate beyond. Um, this will reduce readmissions, uh, re, reduce readmissions 12 months from now. That's just a harder story to quantify. And so in Aunt Bertha's point to your question, you know, managers at health systems were already coordinating. Hey, it seems like you had a challenge finding housing after you were discharged last time. Here's some services that we know in the area that we can help you find. And previously, that used to be a binder or a folder that they had, and it would take them, and it was never up to date. And so Aunt Bertha kind of digitized that entire process and allowed them to send digital referrals and organize all of that information internally. So it fit within the workflows, and then it helped make that kind of department much more efficient. And there is a real story on folks, not returning to the health system if they're given access to these resources.
Yeah, and more so than it was. I mean, there were just really great case studies, right?
There's great case studies at leading health systems, and also I think there has just been an increased realization over the last few years about the importance of this topic, both at health plans and at health systems.
Mm-hmm. So when looking at healthcare, like where do you feel like the biggest areas of opportunity are, knowing how incredibly difficult this nut is to crack?
Yeah, I think that specialty. So Medix infusion is in the specialty drug space, and I think that there's still significant opportunity to address costs in that world. Medix is doing it by providing access to lower cost of care sites, but um, these drugs cost a significant amount, and a few people at an employer can significantly change the employer's healthcare budget for the year if they go on to specialty drugs. And so, helping employers manage that challenge, helping health plans manage that challenge, helping um, provide transparency around PBM negotiations, which are the folks that basically are health plans for drug management for employers. I think there's still significant opportunity to fix a problem that is driving healthcare costs across the industry from a specialty drug standpoint.
So that would be if I'm an employer and I'm self-insuring my employees, being able to make sure that my employees are not getting the most expensive drugs or expensive treatment. So really, the employee is taking over your care management.
In some ways, yeah. I mean, I think maybe 20 years ago, employers were scared to death to say you don't have access to this drug or this provider. But now that healthcare costs have skyrocketed and continue to do so, and there's no end in sight, they're increasingly willing to steer or reduce access to a provider or a drug that is not providing the quality, or that has a cheaper substitute like a generic drug or
But why should that fall on the employer? You know what I mean? Like, why does the employer have to do that?
Well, others who could be incentivized to do that in the system may not always be incentivized to do that. And, some would say that the health plan should be doing that. I think employers are going to increasingly hold health plans accountable to do so.
Because they don't want their side of the premiums to keep raising.
That's right. That's right.
Right. And then what about the deductibles? Like, I mean, like, how are these deductibles like going up as high as they are? I mean, I was looking at a chart the other day and it looks like it's insanity. I mean, like, I think United Healthcare has grown faster than some of the biggest tech companies on the planet.
Yeah. I mean, as healthcare costs have risen, driven by the market power at many healthcare systems, the employers have tried to shift as much of those costs as they can onto their employees. And so you've seen the rise of high deductible health plans, particularly for young, healthy workers. I think we've reached about as far as those high deductible health plans can go. I think there's been as much cost shifting as there can be, but and that's why kind of the next iteration of cost management for the employers, I think, will increasingly be reduction in choice.
Yeah. Okay. I think that's right. I think that makes sense. And, it's on them to say, like, you want cheaper insurance. You don't want to pay an $8,000 deductible.
Right.
If you sprain your ankle,
you
then
you can either have access to everything and have it be expensive, or you can have a little bit reduction in choice so that the folks that are negotiating on your behalf are able to do so. And that's what really brings down costs.
Okay, cool. So employee-based cost control within healthcare, whether it be on an IT or a tech-enabled. I got a question for you. So, you look at, healthcare services and you look at, this space called tech-enabled services. And a lot of people, I believe, don't know what a tech-enabled service is and like what defines it. A company with software versus with proprietary, than in a tech-enabled service. So, how do you think about that?
Yeah, I mean, so like an example would be if the company's just giving you a login and password, and then you're doing everything from then on out, like pure SaaS. If there's a software solution that's used internally by a vendor to help provide a service that is more efficient, kind of think about that as tech-enabled service. I'll give you an example. We invested in a company called Cariloop that provides benefit to employers that helps with employees who are supporting aging loved ones or children, or particularly children with special needs. And Cariloop is not a software as a service company. They believe that you need to have humans helping assist employees with those challenges, because every kind of scenario is highly unique, and so it requires a concierge kind of white glove offering. Now, Cariloop's kind of what they refer to as care coaches who help the employees. They have a software that they use to communicate and log documents and advanced care planning, and provide content and resources to the employees. And so there's kind of a tech-enabled element that utilizes Cariloop software, but they always will have a human element to help employees.
Yeah, there's a cost of good of a human in order to produce the value that they were sold on.
Exactly.
Right. And from that perspective, the intrinsic value, of course, is the growth and the cash flows, but how do you look at like just the human capital talent and the value drivers?
Yeah, I mean, it certainly is more challenging to have required to staff up, a large kind of human capital intensive organization, particularly in this labor environment, versus building software and then being able to use that, via the cloud and deploy that across the U.S. without additional kind of labor. But if you can't sell the software without the human element because kind of that piece is required. You probably need to go the human way.
Right. Exactly. Solve the problem first and then worry about the margin optimization later.
Exactly.
So, what about, so that really sounds like a full end tech enabled service. What do you think about like the like the healthcare staffing companies that are essentially just, staffing companies that, they can, onboard nurses, right? And, doctors and stuff. And then they've got, a repository of them and they can ship and they can schedule, the people. Because I look at services like that and I really look at gross margin. And if I like look at a comparable and say like, okay, well, their gross margin really isn't any better than a publicly traded company that's just a traditional staffing company. I really look at the technology. Like you either have to sell your product as a premium to the rest of the market, or you have to have such good efficiencies that, that you can actually deliver the product at a much, higher penetration than the rest of the market.
Yeah, I think ultimately, like, you have to provide value add beyond just matching, or you'll end up kind of like an Uber Lyft scenario where it's a race to the bottom from a margin standpoint. In your example, I think a value add could be, hey, here's a scheduling tool that will integrate with your solutions that you don't have to worry about that. Or hey, based on your claims data or schedules, we expect you to, using our demand forecasting analytics for your labor work, you're going to need to hire X nurses next week and for these time slots. And that helps maybe a nurse manager better manage her workforce and labor. But if it's just, hey, I need a slot filled today, and I'm going to look in this app, I think that's a tougher solution.
Yeah, it's a tougher solution. The moat's really not there, and the margins are ultimately going to get compressed.
I agree.
Cool. So, does a contract need to be recurring in order to be a tech-enabled service in your mind?
I think that there can be tech-enabled services without recurring revenue. All of the kind of virtual care, like teledoc models, I would argue are tech-enabled services. Mm-hmm. Teledoc has a recurring revenue model with employers, but there's also direct-to-consumer models like a HIMSS or a Row that are tech-enabled services that have someone on the other side of the computer screen that are connected via technology, but those are, pay per use. And so I think the revenue model doesn't drive the, you can have yes and no is a good way to answer.
Mm-hmm. So how are you? No, thank you so much for giving us all that background and how you think about kind of the world and healthcare and the different, I think the big elephant in the room right now with all investors is, especially investors that are less, venture-y or venture capital type where, binary outcomes, let's have, really good returns, but let's not try to have too many zeros. How are you looking at today's marketplace in terms of valuation and all the capital that's out there?
Yeah, I mean,
I love that sigh. that sigh was so real, man. I mean, it was real. I like it.
Yeah. Look, I think everyone kind of thinks similarly about it. There's been just an incredible amount of funding that's been raised. I mean, particularly in my world in digital health, I think, the amount of capital doubled last year versus the record the year before. So you've just never seen anything like it. And in healthcare IT, there's not a crazy amount of huge exits. And so just doing the math, some of that capital will not yield high returns.
Why is that? Why aren't there giant exits in healthcare?
I think part of it is the market is just smaller. You can only sell to so many health plans. You can only sell to so many
interesting
hospitals versus selling a cybersecurity solution that is applicable to anyone who uses the internet.
Or drugs, right? Where it's like like the people
anyone who takes medicine, and to your
Right.
point.
Yeah.
So I think that's part of it. And so I think there won't be as many exits, but I don't think that you've seen public markets come down for some of the high growth, high burn companies. We haven't seen it really yet that much at our stage, kind of Series A, Series B. We've heard inklings kind of from the later growth equity firms that that there has been maybe some valuation pullback, but yeah, it feels like maybe the circus will end over the next 12 months with just because people eventually realize there's too much capital flowing to ideas or projects that won't generate returns on that capital. But it will take a long time for people to realize that because so much capital has been raised.
Is that new funds or just bigger existing funds?
I think it's a combination of new funds, bigger existing funds, as well as investors who are not traditional venture investors, hedge funds, corporate funds that have been launched. There's
Yeah,
just
these hedge funds are killing us, man. Like they're absolutely killing us. I literally, I'm an LP in a really great hedge fund, and they called me to pitch me their late stage growth fund. And I literally almost hung up the phone on them. I was so pissed. I was like, literally, like, do you realize that you were like causing the biggest problem? And the fact that you just want to jump, because there's alpha there and compete against the now 20 soft banks, you're high. If you
yeah.
think I'm putting $1 in that.
From my understanding is that you've seen some of those leave the private markets a little bit over the last few months as the public markets have snapped back to reality a little bit sooner than the private markets. So I think hopefully you'll see some of that leave a little. We'll see.
Yeah, well, I think they had to, right? And I think they had to pull back because they had limited partners in the hedgy world and the same limited partners in the late stage growth. And it's a conflicting story if you're selling, on the public side, but buying on the private side.
Yeah, yeah,
So it's a really mixed message. And I really think that the biggest risk you can take right now in venture capital is the super earliest stages, because A, you can be default dead for not having product market fit, and B, you're paying a multiple that's it's not even a multiple of revenue because they don't really have anything substantial. Now we're at 10 to 20, right, on seed deals and valuations, not rounds. And the late stage is well, my investment thesis is, man, I really hope I don't overpay here, right? Like when I go public, and everything else in between is hodgepodge of venture capitalists, family offices, and now these very efficient debt vehicles. Are you seeing the debt vehicles kind of bumping up against you at all, like the pipes?
we haven't seen that kind of on our end or in our portfolio. We haven't.
Okay, good. All right. All right. So, what is getting you excited right now besides infusion therapy? Or
um,
besides bags of medicine getting pumped into old people? What else is really exciting you these days?
yeah, we've seen some interesting things on the workforce management. Obviously, for health systems, the you talked about it a little bit with the employer nurse matching solutions, but actually trying to solve the problem for these health systems and not provide kind of a band-aid, whether it's employee engagement software or additional supplemental benefits for nurses. I think if you talk to health systems, that's by far their number one problem. So I'm trying to find
Turnover.
something kind of in that space.
Yeah, yeah. Turnover and staffing, I think, is huge. I've seen more HR tech than I think I ever have right now. It's unbelievable.
Yeah, yeah.
And I think everyone's buying something to try it out, but it's going to be curious because I don't think the market knows what it wants yet.
I agree. It's just such a hard problem to solve that it's hard to provide enough ROI to just be able to sell through the health system sales cycle. I think the other thing, like around labor, is just on the employer side how hard it's been to both recruit and retain, particularly diverse and inclusive workforces. That has been a challenge with employers, and I think you'll see additional benefits that you might not have seen offered by employers.
Okay, cool. And then what are you reading right now? He's looking at his desk. He's like, I just read this white paper on.
No, I just finished this awesome book called A Gentleman in Moscow. That it's kind of a fiction of from Russia in the early 21st century, and then I'm now about to start reading a World War II book. Before that, I read if we want to do the like cool VC book before Gentleman in Moscow, I read Signal and the Noise, which I thought was pretty good, by Nate Silver.
Yeah. You got to have a cool VC book.
Yeah.
Yeah. I think I get a quarter of a way through like the cool VC books, and I just put them down. My ADD is like it's so high right now, and I'm just like a really bad phone addict, so it's hard for me to stay focused on an analog piece of paper.
Yeah, and it's like 5 months go by, and you're like, I'm on chapter 4.
I know, exactly. Who do you like to follow online?
One awesome follow on Twitter, especially if you're interested in healthcare policy and drug pricing. Former professor of mine at Kellogg, named Craig Garthwaite.
Whoa! You were a Chicago guy?
I did go to Kellogg. Yep.
Wow. I should have looked at your LinkedIn a little bit harder. You know what I mean? You had so many jobs and experiences, so it was hard to get down to the education piece. Were you fired a lot, or, do you just kind of move around a lot?
Just two other jobs before this. But yeah, he's one of the leading kind of drug pricing and policy experts, and just a great follow on Twitter.
Does he get hated on like everybody else in Twitter? I don't get Twitter.
I think sometimes he typically takes the side of high drug prices are not bad because they drive innovation and access to future drugs for patients struggling from diseases.
I'm sure that goes over really well.
I broadly agree with. But
wait, so you're saying that high drug prices are good because it creates innovation? Are you saying?
Right. Yeah.
Okay.
That's it. You can see how it's an easy argument to
right.
vilify.
If you read the first half and not finish, right, which is anyone's attention span.
Right.
Cool. And so how can people get in touch with you? I got a hot healthcare service, tech-enabled software company. What's the best way to reach out to you, follow you, learn more about you and Noro Mosley?
Yeah, I would probably go to Noro Mosley's website, and through there, like myself and our team's kind of LinkedIn. We've got contact us through our website. But yeah, reaching out to me via LinkedIn is probably the best route.
All right. That's Ryan Collins, everybody, from Noro Mosley. We covered, different topics around healthcare IT, behavioral change, what constitutes a platform, along with underwriting deals in the kind of the Series A and Series B stage. Ryan, thank you so much for coming on. I really appreciate it. And I will talk to you later, my man.
Thanks, David. Appreciate you having me on.
All right. Bye.